Did you know that just one small oversight could drop your credit score significantly, making it harder to get loans, buy a house, or even rent an apartment? Credit scores impact so many parts of our lives, and yet, hidden threats can damage them without you even realizing it. In this video, we'll go over 10 essential tips to help you protect your credit score from these hidden threats. Tip number 1. Monitor your credit report regularly. One of the simplest but most powerful ways to protect your credit score is by monitoring your credit report consistently. Errors on credit reports are surprisingly common and can significantly impact your score. For instance, you might find an old account that should be closed, incorrect balances, or even accounts you didn't open, often due to mistakes or potential identity theft. Fortunately, you're entitled to one free credit report per year from each of the major credit bureaus, Equifax, Experian, and TransUnion. By checking your report regularly, you can catch errors early, dispute inaccuracies, and keep your credit score healthy. Look for any unfamiliar accounts and make sure your account balances and personal information are up to date. This proactive step will help you avoid unnecessary damage to your credit. Tip number 2. Set up alerts for suspicious activity. Setting up alerts for suspicious activity is an easy way to catch potential threats to your credit score early. Most banks and credit monitoring services offer real-time alerts that notify you of any unusual activity, like a new account being opened in your name or a large purchase made on your card. These alerts allow you to respond quickly if there's a breach. Imagine getting an alert about an account you didn't open. Acting right away means you can shut down fraud attempts before they affect your credit score. Check your bank or credit card app for alert options, and sign up for notifications about transactions and new accounts. These alerts are invaluable in protecting your credit from unauthorized activity. Tip number 3. Limit hard inquiries. Every time you apply for credit, whether it's a credit card, a loan, or a new line of credit, it triggers a hard inquiry on your report. Too many hard inquiries within a short period can temporarily lower your score and may signal to lenders that you're financially stretched. A common mistake is applying for multiple credit cards or loans at once, which can have a lasting impact. However, if you're planning a big purchase, like a car or home, you can minimize this effect by shopping around within a specific time frame. Credit bureaus often treat multiple inquiries within a short period for the same type of loan as a single inquiry. So, if you're looking to make a large purchase, be strategic and keep your applications within a 30 to 45-day window to avoid unnecessary hits to your score. Tip number 4. Pay bills on time every time. This tip may sound straightforward, but it's crucial. Your payment history makes up a large part of your credit score, about 35% for most scoring models. Even one missed payment can cause a noticeable drop in your score, and late payments can stay on your report for up to 7 years. So, consistency is key. Try setting up automatic payments or scheduling reminders on your phone to ensure that every bill is paid on time, from credit cards to utilities. Even if you can't pay the full amount, making at least the minimum payment on time is better than missing it altogether. Keeping a flawless payment record is one of the most effective ways to build and maintain a strong credit score over time. Tip number 5. Reduce your credit utilization ratio. Your credit utilization ratio, the percentage of your available credit that you're currently using, is a major factor in determining your credit score. A high ratio suggests that you're reliant on credit, which may be seen as risky by lenders. A good rule of thumb is to keep this ratio below 30%. For instance, if you have a credit limit of $10,000, try to keep your balance under $3,000. If you're using more than this, consider making multiple payments throughout the month to keep your balance low, or ask for a credit limit increase if you're eligible. By keeping your utilization rate low, you're showing lenders that you can manage your credit responsibly, which positively impacts your score. Tip number 6. Avoid closing old credit accounts. Many people assume closing old credit accounts will help improve their score, but this is actually a myth. The length of your credit history is another key factor in your credit score, and keeping older accounts open can work in your favor. Closing an account reduces your total available credit, which could increase your utilization ratio. Additionally, it can shorten the average age of your accounts, which may lower your score. If you're worried about overspending, consider cutting up the card or storing it somewhere safe rather than closing the account altogether. Keeping your oldest accounts open and active, even with minimal use, is beneficial for building long-term credit health. Tip number 7. Regularly update your personal information. Outdated personal information on your credit report can lead to confusion, errors, or delays in processing applications and credit checks. It's important to keep details like your address, employment information, and other identifying details up to date with all your creditors and the credit bureaus. If you move or change jobs, notify your creditors and update your credit report if necessary. This not only reduces the risk of errors but also ensures smooth processing for any credit-related inquiries or applications in the future. Having accurate information on file also helps prevent issues if someone tries to steal your identity using outdated information. Tip number 8. Be cautious of co-signing. Co-signing a loan or credit card for someone might seem like a helpful gesture, but it comes with risks that can impact your credit score. When you co-sign, you're legally responsible for the debt if the other person doesn't make their payments. If they miss a payment or default, it will appear on your credit report and can lower your score. Think carefully before co-signing and be aware that your financial health is on the line. If you must co-sign, make sure it's for someone you trust completely, and check in periodically to ensure payments are being made on time. Tip number 9. Avoid overlapping major purchases. If you're planning on making a big purchase, like buying a car or securing a mortgage for a home, it's essential to avoid overlapping this with other major credit-dependent purchases. Here's why. Each time you apply for a loan or open a new credit account, a hard inquiry is added to your credit report. This may seem like a minor action, but when multiple hard inquiries stack up, they can signal to lenders that you're taking on significant financial obligations or, worse, that you're financially stretched. This can lower your credit score temporarily, as credit scoring models may view multiple inquiries within a short period as a sign of risk. For example, if you're planning to finance a new car, avoid opening a new credit card or applying for another loan in the weeks leading up to or right after securing the car loan. Each of these actions increases your debt-to-income ratio and credit utilization, which can contribute to a drop in your score. Even if your score only drops by a few points, it can make a difference, particularly when you're in the process of applying for credit that requires a higher score to qualify for favorable interest rates. For example, a few points can mean the difference between securing a great rate on a mortgage or paying thousands more over the life of the loan. Instead of stacking purchases and credit applications together, space them out to allow your credit score to recover between each one. If you're looking to make more than one large purchase, try planning a timeline. For instance, if you need both a new car and a new appliance on credit, make the bigger purchase first and wait a few months before applying for another line of credit. This spacing lets your score stabilize and recover, keeping your financial profile healthier over the long term. A general rule is to give it at least 6 months between major purchases when possible, allowing inquiries and any added credit utilization to balance out. Finally, if you're working on a significant financial goal like purchasing a home, try to avoid any new lines of credit entirely for at least 6 to 12 months leading up to your application. Home lenders often scrutinize your credit activity for months prior to your application, so keeping a clean slate of credit activity during this period can help improve your chances of securing a favorable rate. This long-term approach to your purchases and credit applications not only protects your credit score but also keeps you better positioned to handle each new financial responsibility. Tip number 10. Use a credit monitoring service. Using a credit monitoring service can provide an extra layer of protection for your credit score and overall financial health. These services keep an eye on your credit report, alerting you to any changes, including new accounts opened in your name, recent hard inquiries, and significant score fluctuations. Many people believe they'll notice signs of fraud or identity theft on their own, but it often takes months or even years to catch these issues without dedicated monitoring, by which point the damage to your credit score can be substantial. Credit monitoring services are valuable because they can notify you of activity in real time or as it happens, giving you the chance to address issues immediately. For example, if someone tries to open a credit card in your name, the service will notify you so you can act quickly to report it as fraud. This early detection is crucial, as catching fraudulent activity right away can prevent a major hit to your credit score and save you hours of dealing with creditors to remove unauthorized accounts. In addition to fraud alerts, some credit monitoring services offer other helpful tools, like access to your credit report and score, tips for improving your score, and insights into what actions will positively or negatively impact your credit. Some even offer dark web monitoring to check if your personal information, such as your social security number or credit card numbers, is being sold or shared on shady websites. This extra level of protection is especially important in today's digital age, where data breaches are frequent, and personal data is increasingly vulnerable. When choosing a credit monitoring service, look for options that fit your needs and budget. Some banks offer basic monitoring for free as part of their account services, while other credit bureaus provide more comprehensive monitoring for a fee. If you're looking for a free option, there are services like Credit Karma that offer basic credit monitoring at no cost, which includes alerts for significant changes to your report. For more robust coverage, paid services like Experian's IdentityWorks or LifeLock offer in-depth monitoring, dark web scans, and even insurance to help cover any losses due to identity theft. Regularly checking your credit yourself is helpful, but it can't replace the benefits of a monitoring service, especially if you're busy or simply want peace of mind. The cost of a paid service may be well worth it for the protection it provides, especially if you've been a victim of fraud in the past or want extra reassurance. Think of it as insurance for your credit score, with alerts to potential threats and access to resources to protect yourself. With a monitoring service in place, you can sleep easier knowing that your credit score is constantly watched and protected, keeping your financial life safe from unexpected issues. To conclude, protecting your credit score is all about being proactive, staying vigilant, and knowing where potential risks lie. By following these 10 tips, you're not only safeguarding your credit score but also setting yourself up for financial success. A strong credit score opens doors to better interest rates, loan approvals, and financial opportunities, so take these tips to heart and keep your credit score in top shape. If you found these tips helpful, don't forget to like, subscribe, and share this video with anyone who wants to strengthen their financial security.